We're now going to be looking at head and shoulders patterns. Now, head and shoulders patterns are a reversal pattern which is identified by a change in cyclicity at the end of a trend. Head and shoulders give us frequent good trading opportunities that we can take advantage of. If we draw on one of the head and shoulders patterns on this chart now, we see this first shoulder that gets formed to begin with and is a swing high. We then see the head that gets formed, and we then see the lower high here, which is the second shoulder being formed as well. And we can see shoulder, head, shoulder, which gives us that head and shoulders pattern. Now, a simple way to then trade this is to then take advantage of the opportunity by selling, in this case, underneath the break of the low through here. And there's two potential places to put a stop loss. The first being in the safest possible place. Gives you a larger stop loss, but gives you a safer, higher probability trade. Or alternatively, behind the most recent swing high, in order to give a slightly lower probability, but a better reward to risk. So it's kind of down to whether you want the higher probability or the higher reward to risk. Depending on which way you want to go, gives you the stop loss that you want to use. But it should be either behind the head or behind the shoulder, this being the higher reward to risk trade, this being the higher probability trade. Depending on your psychology and your trading profile, that will depend on which way you choose to trade. But we can see clearly the first shoulder, the head, and the second shoulder of that pattern. If we want to have a look at another head and shoulders pattern, we've then got the shoulder here, followed by the head being formed, followed by the lower shoulder being formed. Now we can see in this example, having an entry point around this area here makes a lot of sense. And having a stop loss around this area here again makes a lot of sense. It wouldn't be sensible here to put a stop loss all the way up here. First of all, because you're risking 1,000 pips or 950 pips, which is absolutely colossal risk. But also because of the fact you've got to make 1,000 pips just to make 1%, which of course is incredibly unlikely to make 1,000 pips just from one trade. Therefore, in this example, it's much more sensible to have a smaller stop loss, in this case 285 to 300 pips. On a daily chart, of course, the smaller the chart time frame you go down to, the smaller the stop loss. Now, what's interesting is that there's another head and shoulders on this chart that we're looking at, but it's an inverse head and shoulders. We can see the move down, the pull back, the move down again. So we see the first shoulder that's been formed. Of course, this is an inverse. We see the head now being formed, and then we see the second shoulder being formed. Again, we're looking to take the break of that shoulder line, so we'll look to trade from here as our entry, and our stop loss can be either underneath the first shoulder, or to play it safe, it could be underneath the head there to give a higher probability trade. Again, behind this shoulder here, it gives us that higher reward to risk. Behind the head gives us the higher probability. And you can choose which you want to use based on your own trading psychology. And we see how the inverse head and shoulders here and the head and shoulders are essentially mirror images of each other, similar to the double top and the double bottom. What you will sometimes find is that a double top, what you will sometimes find is a head and shoulders can lead to an inverse head and shoulders and vice versa. Looking at the euro-dollar chart here, we can identify on the chart a shoulder, we can also identify a move here, the shoulder, and of course we've got the head there as well. So shoulder, head, shoulder, that's low, lower low, higher low, and that shows us the shift in cyclicity here, low, lower low, higher low, which makes us think the market's then going to go to the upside. This of course then does move to the upside. We would be getting triggered into the trade here. Of course we can see that then moves the wrong way and potentially then stops us out. But interestingly enough now, we have shoulder, head, and actually another shoulder here. So this then develops into a head and shoulders pattern from an inverse head and shoulders pattern. Shoulder, head, shoulder of the inverse head and shoulders. Shoulder, head, shoulder of the head and shoulders pattern. And actually, this trade we can see runs into a small profit, but then turns round and gives us shoulder. We can see the head forming there. And we can also see the second shoulder. And of course we can see that this trade then runs very aggressively to the upside. So inverse head and shoulders becomes head and shoulders becomes inverse head and shoulders. We've taken a losing trade, a winning trade, and then a big winning trade. And just another one on the chart for you as well. We have the shoulder. We then have the head. And we then have the lower shoulder again. And we can see this trade then moved to the downside. So you can identify these inverse head and shoulders, the head and shoulders on any time frame, on any chart, any currency pair, and you can straight away see the frequency is actually quite high. There's quite a high number of these head and shoulders patterns occurring for us to take advantage of. They're probably the most frequent reversal pattern that you're likely to find, and therefore potentially something that you should think about adding to your trading portfolio. They're very easy to identify because all we're looking for a head and shoulders is high, higher high, lower high. They're very easy to identify because all we're looking for on a head and shoulders is high, higher high, lower high, and the inverse, low, lower low, higher low. Go through a currency pair of your choice now. Have a look and identify these head and shoulders and inverse head and shoulders patterns on your charts. Make sure that you're happy with them. familiarise yourself, and then move on to the next section.